Welcome to this explainer. Right, let's dive straight in. If you look at the landscape of quantitative finance today, you're going to see this massive, honestly almost overwhelming, ecosystem of Python libraries. For a developer or an analyst trying to navigate this space, well, it can feel like staring at a giant puzzle with 1,000 scattered pieces. But today, we're going to demystify all of it. We are going to organize that chaos and trace the exact chronological real-world workflow of a financial developer.
You know, it all really comes down to one incredibly compelling question. How exactly do everyday retail traders build the exact same automated algorithms used by Wall Street quantitative hedge funds? The secret is simply that the playing field has been completely leveled by open-source technology. The exact same computational power and mathematical models used by the big institutions, they're available to anyone with a laptop. So, to solve this mystery, we're going to walk through the journey of a Python quant, step by step, going straight from raw numbers to a fully deployed trading application.
Okay, so this journey kicks off with stage 1, the core data foundation.
Look, before we can even think about complex algorithmic trading, we have to establish a rock-solid foundation to handle raw, messy financial datasets. To do that, every single quantitative analyst absolutely must master these core 4 libraries first. You can kind of think of these as your foundational toolkit. You've got NumPy for lightning-fast math with arrays and matrices, which is absolutely crucial because its vectorized operations save just huge amounts of computing time compared to standard Python math. Then there's Pandas for organizing all that data into labeled tables or series. Once your data is neatly organized, you move over to Matplotlib to build your foundational charts, and then Seaborn, which actually builds right on top of Matplotlib to create these really beautiful polished statistical visualizations. Honestly, you simply cannot skip this step.
Now, here's a really fascinating piece of history. Actually, scratch that. It's the origin story of arguably the most important tool in this entire workflow, Pandas. It was created back in 2008 by a developer named Wes McKinney while he was working at the quantitative hedge fund AQR Capital. He desperately needed a high-performance tool for financial data, and he named it after panel data, which is an econometrics term for data sets tracking the same individuals, or, in our case, financial assets, over multiple time periods.
But here's the catch. A really crucial point is knowing the limitations of your tools. Wes McKinney himself actually gave this incredibly important rule of thumb. See, Pandas is unbelievably flexible and powerful, but it loads your entire dataset into memory to run those blazing fast calculations. So if you're working with massive tick-level financial data, you've got to ensure your machine actually has the RAM to support it. Otherwise, your backtest will literally grind to an absolute halt.
Moving right along, we transition up the complexity ladder to stage 2, financial math and indicators.
All right, so once your data is clean, memory efficient, and beautifully visualized, this is where we start applying very specific financial math to it. Notice how the ecosystem really specializes based on your exact needs. We aren't just doing basic arithmetic anymore. If you need to fit a normal distribution to your returns, or maybe calibrate a volatility model, you reach for SciPy. If you're building a technical trading strategy, you pull in TAlib. And if you're pricing complex derivatives, well then you need QuantLib. Every single tool here has a very specific real-world use case in the Quant's toolkit.
Let's zoom in on TAlib for a second. This library is an absolute staple for quantitative trading strategies. It gives you over 200 technical indicators right out of the box. So instead of manually coding the math for momentum indicators like an RSI or MACD, or trying to calculate Bollinger Bands from scratch, TAlib lets traders instantly compute these metrics to generate automated buy and sell signals. It's a huge time saver. Then on the total opposite end of the math spectrum, we've got QuantLib Python. This is where you really get into institutional-grade, advanced financial mathematics. Quants use QuantLib for the real heavy lifting. Things like calculating the Black-Scholes formula for a European option, modeling stochastic volatility to account for wild, unpredictable market swings, or building complex yield curves. It completely bridges the gap between theoretical financial physics and practical Python code.
Which brings us to what is probably the most critical phase of all, Stage 3, backtesting trading strategies.
Okay, so we've got our clean data, and we've got our mathematical buy and sell signals. Now what? Well, this is where developers test their newly built mathematical strategies against historical market data to see if they, actually work. When it comes to backtesting, you generally have to pick your engine, and 2 of the biggest names out there are Backtrader and Zipline. Backtrader is fantastic for pure Python, local backtesting, where you bring your own data, like CSV files you downloaded from Yahoo Finance or your broker. Zipline, on the other hand, is the classic engine that originally powered Quantopian. It is heavily used in academic quant research for testing complex factor models and running full portfolio-level simulations across a massive universe of stocks.
But hey, what if you want to seamlessly transition from backtesting directly into live execution? That is where a cloud platform like Quant becomes a total game changer. Quant offers massive built-in cloud data across 50-plus asset classes. We're talking about survivorship bias-free U.S. equities, which means it actually includes delisted companies so your tests are historically accurate, and full options chains complete with risk metrics or Greeks. Normally getting this kind of institutional data on your own would cost hundreds of dollars a month, but they literally build it right into their free tier for testing.
And finally, we wrap up this whole journey with Stage 4, portfolio optimization and deployment. So, picture this. You've actually got a winning strategy that survived backtesting. Now you need to optimize how you allocate your capital and deploy the results so other people can interact with them. For portfolio optimization, libraries like PyPortfolioOpt are incredible. And what's really interesting here is that PyPortfolioOpt isn't just some random script someone threw on the internet. No, it is backed by a peer-reviewed paper in the Journal of Open Source Software. It gives you rigorous, mathematically proven implementations for really complex tasks like mean variance optimization and the hierarchical risk parity algorithm.
Just look at how incredibly clean this implementation is. Under the hood, these tools use convex optimization libraries like CVXP. This lets a quant flawlessly execute a really strict constraint, like capping total portfolio volatility at exactly 20% in just a few lines of code. You don't have to write those incredibly complex underlying optimization algorithms from scratch anymore.
Right, so the very last step of the journey is deployment. You need to show your results to stakeholders, portfolio managers, or your clients. Tools like Plotly Dash let you build and deploy beautiful, highly interactive financial apps and dashboards entirely in Python. In fact, major organizations out there, like S&P Global, use these exact same tools to adapt to market trends with incredibly sophisticated, interactive analytics apps.
Well, there you have it. We've traced the entire journey, from loading a messy CSV in Pandas to generating signals with TALib, backtesting in the cloud with Quantitative, optimizing everything with PyPortfolioOpt, and finally deploying it all with Dash. The barrier to entry? It has completely vanished. With open-source Python libraries now perfectly matching the capabilities of institutional trading desks, what strategy are you going to build first?